Hello and welcome to some people that are already in the group, or if you're watching the recording. So welcome back to Frankly Finance. I'm Gemma Mitchell. This is Lexie Smith. I'm actually really nervous because I had like 2 weeks off and I feel like I've forgotten everything on what we're doing. And Lexie and I are already having a competition on who is more tired and will probably yawn more through.
I'm definitely going to win. I feel like a yawn coming on already.
Yes, and I'm really bad. I'm drinking a Coke trying to wake myself up. Yeah, so welcome back. We're trying to work out what episode this is. I think it might be 13, but yeah, don't quote me. But really exciting today. We're talking about FIRE. So the FIRE movement has had a lot of, it's been really a hot subject in Australia over the last few years and much longer in the US. So for those who aren't aware of it, the FIRE movement stands for Financial Independence, Retire Early. And it's a concept around saving enough and investing so that you can live life on your own terms and so you can stop work. But there's lots of different, so it started as like a really traditional strategy and it's kind of like really evolved and people have had their own takes on it, and now there's like lots of different strategies that you can do within that initial concept, which I absolutely love about it. So we're going to go through that today, and we had some questions come in beforehand, and if anyone's watching live, absolutely put your questions in the chat because we're going to make sure that we really address the questions, because I find that people are usually really passionate about it. They either love it or hate it, or they really just don't understand its value. So Lexie, are you pretty familiar with the concept of FIRE, and what are your thoughts on what it involves?
So financial independence, retire early. I think that I was kind of on that train before it was even had a name, but I don't follow the FIRE community too closely or anything like that, but I can completely appreciate the underlying concept of it. And like anything, there can be varying degrees, as you've kind of alluded to already. So with FIRE, there's a lot of frugality and investing, but it's basically creating a portfolio that you can then have enough income to live off, that you don't have to work anymore, or you can choose when to work, where to work, and that kind of thing. So yeah, it's now got a name and it's very popular overseas, and it's more popular here in Australia. How about you?
Yeah, absolutely agree. I think people get really hung up on the retirement bit. So we're all pretty familiar with the financial independence part, and that's really simple, because while financial independence is different for everybody, that might look totally different to you to how it looks like for me. It might be a family home for other people. It might be income to always pay rent, or whatever that looks like. The financial independence part is pretty easy for most people to grasp. But where I find people really struggle with it is the retire early. So what I think is important here is retire early is a catchy name and it spells out FIRE, but that doesn't actually mean that you have to retire, right? So, and retirement to you might look totally different again. So when I think of FIRE and the retire early part, I think even if I'm loving my work, I'm choosing to go to work because I want to be there, because I could retire. Or retirement might be sipping cocktails on a beach for somebody else and never doing another day's work. It might be quitting work and volunteering. So pretty much take the retirement part out of it and just think of it as choosing to do whatever you want to do with your time. And if that means working and earning more income, absolutely you do that, but you can choose to be there. You don't have to be there. Yeah, that's the bit that I find people get fired up about. But like, for example, when my husband had to retire at 38, people always say, oh, that's so bad. You need to contribute to society, your brain, and you're this and you're that. And I'm like, he's never been more social, never seen more people, never had more projects that keep his brain active. He literally gets to spend his day doing the things that are really valuable to him and meaningful to him and that he enjoys doing. So that's exactly where I see the FIRE movement and what I hope retirement will be like. So yeah, so I think people get hung up on the actual word retirement in there, but if we focus on the financial independence part, that's really what we care about in this whole strategy.
Yeah, and you hear different types of FIRE thrown around, like lean FIRE, fat FIRE, barista FIRE. lots of different types. I think it's probably a new one every day of the week. But things like barista fire, it might actually be that you are in a high stress, high earning job for the bulk of, you know, your working life, and then you decide to retire early, and you decide to work at a local coffee shop a couple of hours a week, and that's, you know, you're still generating employment income, you haven't completely retired, but you do it because you like the social aspect, you love coffee, whatever that might look like. So yeah, exactly. There's no one set way it goes.
I kind of think of it as, and like any time that you reach financial independence, or even, you know, you just have an emergency fund or whatever, it's the reason you do that is so you have choice, right? Choice to go, this doesn't serve me anymore, I'm out of here, leave a bad relationship, leave a bad job. But yeah, so I absolutely love that. But yeah, the main thing is, even if you don't like the name, if you think about it a little bit deeper, I think it resonates with a lot of us. So let's talk about the actual strategy and the math and things for the people that don't actually know what we're talking about. So as Lexie mentioned, it's most people associate it with being pretty frugal, but what it is it's making sure, it's kind of focusing on reducing your expenses, increasing your income, and saving the difference. So the quicker you want to get to financial independence and whatever your retirement looks like, it means that you have to save as much income as you can so that you can invest it. So the more you save, the quicker you're going to get to this, but you can do it in your own time. But yeah, really it's about making sure your expenses and your income, there's a gap, and then you're investing that difference. So the theory behind, well, the math behind this came from a study called the Trinity study. So because we only have half an hour today and we want to do questions, I won't go into it too much, but yeah, Google this kind of stuff. It's so interesting. So it was a long time ago, but they were looking at, well, what is a safe withdrawal rate? What is the amount that if you had an investment portfolio that you could safely take out 1% every single year and really still preserve your capital, still have that money last? And it was based on a retirement. So it was based on, if you retired, you know, and you had to, this money had to last 30 years, how much percent could you draw out every year safely with inflation and stuff? So that Trinity study came up with 4%, and it's been looked at a little bit since, and it's kind of sits between 4 and 5 as being pretty safe. So if you imagine you have an investment portfolio, you can live off 4 to 5% of that every year as your, you know, passive income instead of your employment income. And the money shouldn't run out for 30 plus years. So if you're going to retire much earlier, like if you're going to try and do this and be like 30, the money really has to last you more like 60 years. So you're going to have to be much more conservative. So with this, with any strategy, you need to adapt it to your plan. You can't just go hard and fast, this is the rule, because you've got to see what they based it on. But so the Trinity study is where they got the 4 to 5% for if you're looking at about a 30 year. So how you work out how much money you need to retire in this concept, really simply, again, there's so much more to it, but what they do is they go work out what your expenses or what your goal income is going to be. So what you want to live off.
I think a lot of people might pull a figure out of the air. And my key message there would be actually sit down and try and work it out, because what you think it is probably not what it is.
And have buffers on it, because like right now we've always worked off inflation at 2.5%, and right now it's 7 or something. So like have buffers in there and think, you know, if I am actually, so when you do, when you're trying to work out what your goal lifestyle is, you've got to think about what the goal life is. You've got to think about what the lifestyle is. Like, are you renting now, but you'll be in a house then? Or are you going to be overseas? Or are you going to have 2 cars then, or whatever? So you need to do your expenses based on what that looks like. So once you've got that, so say your goal was, I reckon, $40,000, we'll
put it up. We need more than that.
Well, for the simple of math that I can do in my head.
Oh, yes. 40,000 divided by 4% is $1 million.
Yeah. Or the other way that you do it is you get the amount, 40,000, and you times it by 25, and you get $1 million. So you can divide it by the amount, or you can times it by 25.
So if someone
work out your lump sum. But what I also find that what trips people up is when they're working out these expenses is they always underestimate them, and they don't take into account like unexpected stuff like the car breaking down or having to upgrade a car all of that kind of stuff. They always underestimate, and that happens with retirees as well every time. But they also don't allow for tax. So if you're thinking you've got this big investment portfolio that you're going to retire on, taking 4% out or whatever, you've still got to rely on, you're paying the tax man regardless. So you need to gross it up with tax. You need to have a buffer for your living costs changing and all of that stuff. So that's where people they come unstuck with these types of strategies.
Yeah. So if, say, a family wanted, like, and again, it depends on the age that you're planning your potential early retirement as to whether you still have kids around potentially, but even at an income of 70,000, so 70,000 divided by 4% is 1.75 million. If you needed like 80,000, and as well, you've probably been living a more frugal life, so maybe you don't need that amount of money, but that's the difference in the numbers. So 80,000 divided by 4%, then you need $2 million. But then should we maybe move into, well, how do we develop $2 million as a portfolio or investment to actually generate that income? So it comes down to your savings rate, which a lot of people in the FIRE community target 50% and above. So if you're earning like 100 grand after tax, you need to be saving 50 grand a year.
Yeah.
To have a 50% savings rate.
And I think that savings rate became really popular through the obsession of the savings rate is through a FIRE blogger, Mr. Money Mustache. And you can go and Google him. But he's also got like a calculator saying, well, if you save 50% of your income, this is how long it'll take you to FIRE. If you save 80%, this is how long. So you can kind of play around with that as well. But again, you've got to apply it to your situation and really don't take it as gospel. You've got to do a bit more work around it. But one of the questions that got sent in around this was, so one of the questions that got sent in was, how do we take into account, like especially in Australia, what if we have investment properties and what if we have superannuation? Because it's a lot more straightforward in the US, whereas in Australia with super and stuff, it works a bit differently. So that's a really, really good question. And I think what's important, there's a couple of key things.
Right.
So with superannuation, really, really importantly, it's one of the most tax effective ways to save and invest in Australia. But if you're targeting FIRE and you want to retire early, superannuation has preservation restrictions on when you can get it. So for most of us, it's going to be 60 plus. If you are planning to retire earlier than that, you need to be building this investment portfolio outside of super. But it doesn't mean that, really simply we're going, well, you need $1 million, but potentially you've actually got your superannuation ticking away in the background that's going to kick in at some point. So you might not actually need the whole $1 million in this investment portfolio. You need enough there to bridge the gap between when you're retiring and when you can access super and that come into play. So this is where like a financial advisor is so important, because they can help you with a FIRE strategy. You don't have to do it on your own, and they're going to think of all these other things. So I find in these FIRE movement, like the forums and stuff that I watch, the communities, it's like, I need the investment in ETFs in my own name of X amount, but they're not considering, then your super between the years that you're retired is still going to grow until you can access it and all those other things. So there's lots of ways that you can probably reach FIRE faster than what you think by taking into account those assets. But you need to be smart about, well, you're drawing down specifically on that investment portfolio a lot heavier until your super can kick in, and how they work together.
That is another key part of FIRE. Typically, they target low-cost index funds. There's pros and cons to everything, but that's just kind of the part of the method that a lot of people do follow. It's not the only way, but it is quite widely spoken about.
That's it's pretty much focused. Hey, they look at the returns, they look at the fees and things like that. And the other question that came in was, well, if I've got investment properties, whether it's 1 or 10, how do I take that into account in my FIRE journey? It really depends on what the plan for that property is. Is it that at FIRE, when you reach that age, you're going to sell the property and put it in an investment portfolio? are you going to keep it going and use that income? So it's a lot more straightforward if you're thinking, I'm going to sell it and I'm just going to have this big bucket of money invested and it's all going to be in one place. You would keep your FIRE calculation kind of the same. However, if you're thinking that income's going to come in, I'm going to have passive income from that property, again, considering tax, or it might be other things, like it might be book royalties or income from somewhere else, or, barista, you're working a little bit. I think the easiest way to work that out is work out the expenses, your goal income, then take those income amounts off, and then set your FIRE number at the lower amount. That's how you do it, right? So say you wanted 60 grand a year, but 20 of it was going to be coming from somewhere else. You would calculate your FIRE number off 40,000. That's how much you've got to have there, and you've just got to make sure that you're actually realistic with that other income, what that's going to be, and if that changes, you've got to adjust it. But that's how I'd work out my FIRE number to keep other investments and other income considered in it.
We've had a question come through in relation to whether there is a certain age where it's too late to start FIRE. What would you say to that?
I think it's never too late. Like if you're 70 and you have no ability to retire, you need to start your FIRE journey then, right? So like, I don't think it's ever too late to be looking at financial independence. Yeah, if you haven't reached it, you've got to be working towards it at some point. But with anything, obviously the earlier that you start, the easier it is, the less you have to do, right? Like the less you have to save and contribute because compounding interest is on your side. But I don't think it's ever too late.
You could be a 20-year-old with a capacity, like a savings rate of next to nothing, and save $1,000 a year, or you could be 45 and have capacity to save $100,000 a year. In which case, it's hard to answer that question. Is there an age where it's too late to start? Because everyone's situations are so different.
You'd probably, that savings rate. So yeah, I think there's a calculator on the Mr. Money Mustache website. So you look at it for your personal situation. Go in, work out how much your FIRE number is, what your savings rate is, and see how many years it is. And as long as you're still alive within that period, then it's not too late.
Yeah. I might even see if I can bring it up and we can screen share. But with the savings rate, that's something that I talk to some financial coaching clients about, as to working out, well, what is your savings rate? Because most people do not know what their current savings rate is. They know the amount, the dollar amount that they save, but they don't know the percentage that they save. I had one client who already had a savings rate of 50%. And they actually wanted to further increase that. And that was possible because of their incomes. They could realistically save more than 50% of their income, but that's not always going to be the case.
And it's going to change as well. Like this is like any budget goal. You need to adjust it because your income, your spending, and your goals are going to change, but also, what you're trying to achieve. So I kind of think people fixate on this number, their FIRE number, but that's a kind of moving target with inflation and expenses and when our lifestyle priorities change. So I love the concept of having something to work towards, but it is something that it's going to be a moving target, and you need to really be on board with being flexible with it, and your priorities change. So there's lots of things to love about it. What I love about it is pretty much that it gets people thinking about another way that they could live and what the priorities are in their life and what they want to do with their life and how their money can work for them. I don't love so much the really, really, no offense to anyone watching, the really, really like hardcore FIRE people that are like frugality, like cut everything out right now, live a horrible life right now so you can retire really, really quickly.
I think it's like anything. You can go on a really strict diet with a name, like you can be on a keto diet or whatever other kind of diet, or you can still achieve similar outcomes, but by just simply being more mindful and intentional around things. So that's kind of my personal method in relation to not necessarily being super strict and following a set of rules, but by being aware of it, being intentional, being mindful, because that also allows us to really embrace the current, what you want now as well as in the future, because the future, like, you might not actually get there.
That's exactly right.
We've had another question. You'll love this, Gemma, because it's about super and you are obsessed. What is the strategy for managing your super while reaching retirement? Invest in which area? If in fixed interest, it won't generate enough return for retirement versus in shares.
Okay, so like anything, so right now we're talking about FIRE, which is it's really common for people to look at diversified share portfolios like ETFs and low cost things, outside in their personal names. But really, whether it's super or it's in your personal name, it really comes down to your risk appetite and your time frame. So how long you're investing the money. For most of us with superannuation, it's a minimum, 40-year time frame between when we start working and when we can access it. But even when we do access it, it doesn't generally get pulled out and sold down in cash. So even your time frame's even longer, how long that money lasts. So super's a really, really long-term investment. So majority of people, we find that they're more comfortable with taking a bit more risk in there. But I think regardless of what your risk profile is, whether you want to be a bit conservative and not have it too volatile, or whether you're happy to be quite aggressive and take big highs and lows, it needs to be diversified either way. So one of the examples here was if it's in fixed interest, it won't generate enough return. You would never want a portfolio purely in fixed interest. You want to have all these different asset classes that work together and have different percents in them that you're comfortable with. So they're all doing different things. Fixed interest can perform well when shares and things aren't. Shares can perform really well when fixed interest isn't. So it's about finding the balance for you and reviewing it, because as you get closer to retirement, maybe you want to be a bit more conservative than what you would be if you were, 40 years away from retirement. If you're not sure, I'd be looking at your superannuation, how it's set up now, looking on the website of the super fund and looking at how they like other investment options that they've got and how much risk they're associated with and things like that. And then there's companies where you can go and get digital financial advice that just looks at your super and your risk and how you should invest in it. Or you could go see a financial advisor and they'll look at everything for you, your super strategy, your FIRE strategy outside, your insurance, and all of this stuff. We haven't made that point, right? Insurance, like protecting your income, is a major consideration with FIRE. You're cutting all these expenses, but if your income's gone, you can't save. So to do strategies like this, you need to increase expenses in some areas, like paying for income protection that can protect your ability to even achieve this.
If anyone is wanting to do a little bit more reading in relation to that particular question, the words that you're searching online are asset allocation and diversification, because that will help you understand Gemma's answer as well to that question. And as well as like digital advice and seeing a financial advisor, you can also speak to your super fund directly. There's obviously pros and cons to all of those different options, but quite often you can get advice on the investment option within your fund from your super fund for no additional fee potentially. So it's worth knowing what paths you have that you can take so you can make a more informed decision as to who to speak to about these different things.
Yeah. And regardless of that question being around super, it's absolutely something for those to consider who are going to start aggressively, investing their savings in an investment portfolio outside super. Yeah, because you need to have that consideration as well. Like, are you going to invest in ETFs? Are you going to invest in direct shares? Are you going to invest in property? Are you going to be diversified or in one asset class like Australian shares? So that's a really big consideration as well. And depending on how long you're looking between start and getting to FIRE, when you start using the money, your time frame is a big consideration there. If you think you can reach that in 5 years, are you going to be very aggressive with your investing, or are you going to be more conservative, which will mean less time, but the money will be potentially a bit safer? So there's so many considerations out there. Yeah, it's just about finding that balance and what you're comfortable with.
And there's things that can throw a spanner in the works, like kids, maternity leave, maybe health within the family where you're taking time off, lots of different things like that. But the one thing that I do really like about us even having this conversation is that it's bringing an awareness to it. It's increasing the dialogue and the conversation around it so that because retirement and financial independence is quite often something that a lot of people dig their head in the sand about it, and they just don't really want to deal with it because it all seems too hard. But this is at least like a bit of a method and things that you can calculate, that you can work through to see where you're at, see what you need to do to make a change. So I'd say just starting, like if you're kind of interested in what we're talking about today, and you maybe this is the first time you're hearing about it, just go and work out what your current savings rate is. Like just break it down into baby steps. And that would be step one. What am I currently saving?
Mm-hmm. And then step two would be, am I happy with that savings rate, or do I actually want to set a goal to increase it? And if that's a yes, you'd look at your spending and prioritize. You know, am I spending stuff, like are there subscriptions and stuff there that I'm not actually using, and me saving more to get out of a job I don't like or have more choices is more important to me right now? So that's a really great way. When you know what you're trying to achieve, then you can prioritize your spending and go, you know, why am I just paying for stuff that doesn't bring value to my life if it's stopping me from getting me where I want to be?
Yeah. And we've spoken about this before, and it's something that I say at least once a day. There is a limit to how much you can reduce your expenses. You still need a roof over your head. You still need food, all the rest of it. There is no limit on what you can earn. You can earn $40 billion if you can find a way to make it happen.
And we've got an episode on that. So if you've cut all your expenses and you want to say, what's the next step? We do have an episode that you'll be able to see in past recordings that's all about other ways to increase your income. That's not just about side hustles, you know. So that, I think that's episode 10, but we can link that in these notes as well.
Mm-hmm. Cool. Yeah. Any other questions before we wrap it up?
No, I think that was it that had come through before and that was in the group. But yeah, key takeout is you don't have to love everything about this. You don't have to be super frugal. You can make it whatever you want. Prioritizing, about prioritizing what's important to you and having a goal around it, right?
Having a plan.
Yeah, it's just the awareness of it and knowing that if this is important to you, there is a strategy that will help you, but take what you want from it and adapt it and just have fun with it.
And come and listen to us next week.
Awesome. All right. Well, we will see you guys. Thanks for watching and thank you for all the questions. And we'll see you next week at 11 o'clock.
Cool. Bye.
Bye.